Have you ever wondered what's happening inside those sleek AI-powered investing apps? You tap a few buttons, answer some questions, and poof, a personalized portfolio appears. It feels like magic, but it's not. It's a fascinating blend of data, algorithms, and financial theory. Today, we are pulling back the curtain to reveal exactly how these AI apps choose your stocks, and more importantly, how you can learn from their methods to become a smarter investor yourself. First, let's get one thing straight. When we say AI in most investing apps, we're not talking about a self-aware robot from a sci-fi movie. We're mostly talking about sophisticated algorithms and what's called robo-advisors. These are automated systems designed to build and manage your investment portfolio based on rules and data. The intelligence comes from their ability to process vast amounts of information way faster than any human ever could. So, how does it all start? The first step is all about you. When you sign up for an AI investing app, it will ask you a series of questions. Think of it as a financial checkup. They'll ask about your age, your income, your financial goals, like saving for a house, retirement, or a new car, and crucially, your risk tolerance. Are you the type of person who can sleep soundly if the market drops 20%, or does that send you into a panic? Your answers to these questions are the foundation for everything that follows. The AI uses this personal profile to determine the perfect asset allocation for you. What's asset allocation? It's just a fancy term for how your money is divided among different types of investments, mainly stocks, bonds, and sometimes other assets like real estate or commodities. Stocks, or equities, are generally higher risk, but offer the potential for higher returns. Think of them as the engine of your portfolio. Bonds, on the other hand, are typically safer and more stable, providing a cushion when the stock market gets bumpy. They are like the shock absorbers. A younger person with a long time until retirement and a high risk tolerance will likely get a portfolio with a lot more stocks. Someone closer to retirement with a lower risk tolerance will get a portfolio with a higher percentage of bonds. The AI calculates this precise mix to match your profile. Now for the exciting part. How does the AI actually pick the specific stocks and bonds? This is where the core strategy comes in, and for most robo-advisors, that strategy is modern portfolio theory, or MP. It sounds complicated, but the core idea is simple and brilliant. It's all about diversification. The old saying, "Don't put all your eggs in one basket," is the heart of MPT. This theory, which actually won a Nobel Prize, suggests that you can maximize your returns for a given level of risk by investing in a wide variety of assets that don't all move in the same direction. So instead of trying to pick the next big winner stock, which is incredibly difficult and risky, these AI apps buy a little bit of everything. They typically use exchange-traded funds, or ETFs. An ETF is a basket of hundreds or even thousands of different stocks or bonds, all bundled into one single investment. For example, an S&P 500 ETF lets you own a tiny piece of the 500 largest companies in the US. There are ETFs for US stocks, international stocks, emerging markets, different types of bonds, and so on. By buying a mix of these broad ETFs, the AI ensures your portfolio is incredibly diversified across different industries, company sizes, and geographical regions. If one sector, say technology, has a bad year, another sector, like healthcare, might do well, helping to balance out your overall returns. It's a strategy designed for steady, long-term growth, not for getting rich quick. But the AI's job doesn't stop there. Markets are constantly changing, and over time your carefully balanced portfolio can drift. Let's say stocks have a fantastic year and bonds stay flat. Suddenly, your portfolio might be 80% stocks and 20% bonds, instead of the 70-30 split you started with. This means you're taking on more risk than you originally intended. This is where automatic rebalancing comes in. The AI constantly monitors your portfolio. When it drifts too far from your target allocation, it automatically sells some of the assets that have performed well, stocks in our example, and buys more of the underperforming ones, bonds. This is a disciplined, unemotional process. It forces you to sell high and buy low, which is the golden rule of investing, but something many human investors struggle to do because of fear or greed. The AI takes emotion completely out of the equation. Another smart feature many of these apps use is called tax loss harvesting. This is a bit more advanced, but it's a powerful way to improve your after-tax returns. If one of your investments has lost value, the AI can sell it at a loss. This realized loss can then be used to offset taxes you might owe on investment gains elsewhere in your portfolio. The AI then immediately buys a similar, but not identical, investment to keep your portfolio allocation on track. It's a sophisticated strategy that can save you a significant amount of money in taxes over the long run. And it's something that would be very complicated and time-consuming to do manually. The AI does it automatically and efficiently. So, to recap the AI's playbook, it builds a personal profile based on your goals and risk tolerance. It uses that profile to create a diversified portfolio based on modern portfolio theory, usually with low-cost ETFs. Then, it maintains that portfolio through automatic rebalancing and uses smart strategies like tax loss harvesting to optimize your returns. It's a disciplined, data-driven, and long-term approach. Now, the big question: how can you apply these same principles to your own investing, even without an app? First, define your own financial goals and be honest about your risk tolerance. Write it down. Are you investing for retirement in 30 years or a down payment in 5? Your timeline dramatically changes your strategy. Second, embrace diversification. You can build your own portfolio using the same building blocks the pros use. Low cost, broad market, you could create a simple but powerful 3-fund portfolio, for example, with one ETF for US stocks, one for international stocks, and one for bonds. This simple combination gives you massive diversification with very little effort. Third, be disciplined. This is the hardest part for human investors. The key is to create a plan and stick to it. Commit to rebalancing your portfolio on a regular schedule, say, once or twice a year. When the market panics, resist the urge to sell everything. When everyone is euphoric, resist the urge to chase fads. Your written plan will be your anchor in these emotional storms. The AI wins because it has no emotions. Your advantage is creating a system that helps you manage yours. And finally, keep costs low. High fees are a drag on your returns. The AI apps primarily use low-cost ETFs for a reason. When you're choosing your own investments, pay close attention to the expense ratio. Over decades, even a small difference in fees can add up to tens or even hundreds of thousands of dollars. Learning from how these AI systems work doesn't mean you have to abandon them. For many people, a robo-advisor is an absolutely fantastic tool. But understanding the principles behind the magic empowers you. It helps you ask the right questions, understand what's happening with your money, and gives you the confidence to either manage your own portfolio or simply be a more informed client of an AI service. The future of investing is here, and it's powered by data. But the timeless principles of diversification, discipline, and long-term thinking are what truly build wealth. Thank you so much for joining me on this deep dive into the world of AI investing. I hope you found it as fascinating as I do. If you got some value from this video, please give it a thumbs up. It really helps the channel grow. And for more content that demystifies finance and investing, make sure you hit that subscribe button and ring the bell so you never miss an update. Share this video with a friend who might be curious about their own investing app. Thanks for watching, and I'll see you in the next one.